Everything we do is powered. From cooling ourselves from the heat to being able to meet virtually, power is a necessity. Power facilitates economic growth and unlocks new economic opportunities. Offering a solid play on the Philippine power sector is Aboitiz Power, or AP. We, Team Artemis, issue a buy rating on AP at a sum of the parts price target of 45 pesos, presenting a 19% upside. With a market cap of $5 billion, AP is a leading power company in the Philippines. AP is vertically integrated with interests in both generation and distribution. Generation is AP's main earnings driver, accounting for 87% of net income. AP also has 9 distribution utilities, which service more than 1 million Filipinos in Visayas and Mindanao. Our buy call in AP is anchored on first, the quality gains of its existing assets, and second, its aggressive renewables expansion, both of which drive long-run earnings growth. AP trades at a discount to its historical PE and peers, which we believe is unwarranted, as we expect AP to deliver an EPS CAGR of 14% over the next 3 years.
Starting off with their first point, AP's existing generation assets drive consistent quality gains. AP is the second largest power generation company in the Philippines, with 4.4 gigawatts of existing attributable capacity. 95% of existing capacity runs on thermal, geothermal, and hydroelectric energy and are able to serve as baseload power sources. As sources of baseload power, AP's plants directly benefit from first, growth in power demand, and second, increasing electrification in the Philippines. Electricity consumption in the Philippines is expected to grow by a healthy 6% CAGR over the next 5 years, driven by domestic demand. Now, 74% of AP's capacity is contracted, translating to stable revenue and cash flow streams. But AP also enjoys upside from exposure to the spot market, where prices should remain elevated in the near term based on demand-supply dynamics. We forecast AP's existing portfolio of mostly baseload plants with contracted capacities to deliver a 5% CAGR in revenues.
Complementing AP's strong position with its existing generation assets is its aggressive renewables expansion. AP already leads Philippine power peers in terms of installed renewables capacity. It aims to build another 3.7 gigawatts by 2030 en route to having a balanced mix of thermal and renewables capacity. This is one of the most aggressive among Philippine power companies. AP's renewables push comes against a favorable backdrop. Globally, installation and levelized costs for renewables have fallen substantially, translating to cost competitiveness for renewables projects. As of 2020, onshore wind and solar energy now have lower levelized costs than the cheapest fossil fuels. In the Philippines, growth in power demand is expected to outpace incremental capacity additions. This suggests two things for renewables. First, that any renewable capacity that comes online should have ready offtake and limited competition. Second, that renewables should play a heightened role in addressing the imbalance in supply and demand. The Philippine government is aiming to increase renewable share in total generation from 29% in 2021 to 35% by 2030 and 50% by 2040. Supporting this push are regulatory mechanisms such as the Renewable Portfolio Standards, which mandates a higher share of sourced power from renewables, as well as the Green Energy Option and the Green Energy Auction, both of which facilitate contracting for RE capacities. What we factor into our forecast for AP is only 952 megawatts of renewables projects in the visible pipeline. We expect these 8 projects to contribute 5 billion pesos in revenues over the next 3 years. This leaves another 2.7 gigawatts in its renewables pipeline. AP can support this with its robust balance sheet, which has a net gearing of just 0.9 times.
This leads us to our third point, solid base of existing assets and aggressive renewables expansion. We forecast AP to deliver a core earnings CAGR of 14% and an above-average ROE of 16% on the back of top-line gains and improving margins. We estimate generation revenues to grow by 18%, driven by steady utilization in existing assets, fresh contributions from GNPD Unit 2, and new renewable capacities coming online. We have distribution revenues growing by 3% based on population growth in the DU's concession areas. Now, we forecast slight EBITDA margin improvement as we expect cost pressures from coal and oil to ease and distribution margins to remain stable. Over the medium term, we see scope for further margin improvement, with an increasing share from higher margin renewables in AP's portfolio. Supporting AP's long-term growth trajectory is its firm commitment to ESG. AP's largest ESG risk exposure is coal. AP's coal exposure translates to high risk based on Sustainalytics scorecard. AP's foremost response to this is its 2030 goal to reach a 50-50 split between thermal and renewable capacity within its generation portfolio. Worth noting is how AP's greenhouse gas emission intensity has remained stable despite higher capacity coming from coal. AP is a member of the FTSE4Good Index series with strong labor standards and proactive partnerships with host communities and LGUs. On the board, AP has 3 independent directors who oversee ESG, audit, risk, and related party transaction committees.
On to valuation, we value AP via sum of the parts, valuing each power plant and distribution utility. We value AP's generation assets via DCF at a WACC of 7 to 7.8%. We do not assign a terminal value to AP's generation assets and instead discount future cash flows until the end of the plant's useful lives. We also value the distribution utilities via DCF at a WACC of 6.8%. Similar to the generation assets, we do not assign a terminal value to the DUs and instead discount future cash flows until the end of the concession periods. Our WACCs for generation are based on AP's historical beta, while our WACC for distribution uses a relevered beta based on closest distribution peer, Meralco. We note that 95% of our enterprise value estimate is driven by AP's generation segment. At 9 times PE, AP trades below its historical average PE of 12 times. AP also trades at a discount to domestic and regional peers. We believe a re-rating is warranted for AP as we expect it to deliver faster EPS growth and a higher ROE versus its historical performance and peers.
Our valuation is subject to downside risks, with the top 3 being execution risk, operational risk, and commodity price risk. The first risk is commodity prices, with coal and oil accounting for approximately 30% of AP's cost of sales. Though coal and oil prices are expected to soften this year, AP mitigates fluctuations in commodity prices with pass-through mechanisms and commodity swap contracts for its plants. We estimate that a 1% increase in the cost of power leads only to a 1% decrease in our earnings estimate. Second, AP faces operational risk for its plants, which could force the company to source more expensive replacement power from the spot market. Operational risk could arise from lower than expected resource availability and unplanned outages. AP's plants are compliant with the IRC's reliability performance indices and have availability factors above the NERC benchmark. We estimate that a 1% decrease in blended utilization rates for all plants results in a 1% decrease in net income and a 2% decrease in our price target. Finally, AP's renewables expansion comes with execution risk. Though we are confident in AP's 40-year track record in power generation, we also highlight its strategic partnership with Japan power giant JERA. AP's partnership with JERA can help facilitate technology transfer and aid in renewables development. At the same time, removing AP's 954 megawatts of renewables projects with project visibility reduces our price target to 42.5 pesos, still presenting a 13% upside. On the flip side, key upside risks are first, better visibility for the remainder of AP's renewables pipeline, second, an uptick in spot market prices, and third, technological advancements, particularly for battery storage.
We reiterate our buy call on AP at a price target of 45 pesos. Everything we do is powered because of, first, quality gains from its existing assets, second, its long-term growth driver in renewables, and third, its ability to deliver long-run earnings growth. Thank you, and we are now ready for your questions.